Now that things have settled post-budget and enough and more data and information depth is available about key measures taken in the budget, it's a good time for us to understand what next for the Indian equity investors who have been pouring a lot of money into equity markets. The markets post-budget has become extremely volatile and also is gyrating quite a bit on the negative side. Don't worry, this is not a video on the budget 2022, the positives and negatives about the budget, or which stocks and sectors that will be benefited because of this budget. Rather, I thought, let me now talk about what after budget. So in this video, I try to explain the reasons for the recent fall in the market and how to navigate through these periods of uncertainty that may help you to build a sustainable portfolio. And also in the end, I give you an understanding of what kind of returns now you can expect from your investments for the next 5, 6, 10 years period. Let's now start with market information. The year-to-date start that we have seen in the market has not been the best. We have seen negative returns. And of course, post-budget, the markets continue to be negative. While on the sectors, there have been good positives and good negatives. Banks continue to give good profits to the investors with over 10% return, as you can see in the chart. While information technology companies have been breaking a lot of supports, as they call in technical analysis, and have given a negative return of over 10 to 12%. Now you may want to understand why is the market falling even after having such a good pro-growth budget. Let me try and explain that in this next section, and please remember, I will also be giving you an understanding of what kind of returns you can make in the end. If you had read the newspaper immediately after the budget the next day, you would have seen that a lot of these head of large industry houses and service sector companies were talking very highly about the kind of focus the government was bringing on growth sectors, and by focusing India on healthcare, on education, on infrastructure, and also on PLI schemes. They were also very highly appreciative of the fact that the government has been very planned when it came to expenditure, and they didn't do a lot of unnecessary expenditures like subsidy creation or increasing the SOPs. We as middle class didn't have large tax SOPs, which created a bit of a disappointment, I'm sure, in you and me. If you read through the tone of the FM and the Finance Ministry, you would understand that they have started believing that indirect tax benefits will have larger impact than direct tax SOPs and subsidies, and that's why I think going forward we may not really get larger tax SOPs. Now, with all these positive news, then why is the market falling, you may ask? I think there are 5 reasons. The reason for the market fall can be both internal and external. What I mean by external is that big war that can possibly happen between Russia and Ukraine, and there can be a lot of sanctions against Russia. This may lead to some kind of a disturbance between the country's relationship with Russia. Now, the second big impact is the crude oil price going up. We being the largest importer of crude in our bills, I think this will have a larger impact on the market than any other factor that I'm going to talk to you about or I've spoken about. The third and the most talked about event is the Fed tapering. Of course, it's a known event, and I strongly believe that this may not really be the big reason for the market fall. The fourth reason could be that the government focused a lot on capex, but they didn't speak a lot about demand creation. So now if you're an industrialist, you will say, okay, I will set up factories, but tell me, where is the demand? What are you going to do to create the demand? And fifth, the most important point in my opinion, which is hidden, is that let's assume that UP election results come very close and there may be a little bit of a jugglery that the government has to do. They may now resort to giving a lot of subsidies out of their planned or unplanned expenditure, which may disappoint a growth-oriented nation that we are all talking about. And these may be those 5 possible reasons because of which the market is actually coming down. Well, now you may ask, saying, okay, I got the point, what should I do next? Please remember this, and it is very important for you to keep this in your mind. War or no war, easy money or no money, India is well on its high growth path. You may doubt it, but in my opinion, Indian GDP becoming a 5 or a $10 trillion is for real. There may be little delay in achieving this $5 trillion number or a $10 trillion number, but I think the GDP numbers are going to go through the roof in the coming years. Therefore, prepare a portfolio that is going to capitalize on India's high growth path. If there is a war, if there is a Fed tapering, there may be stocks, sectors, companies and funds that may fall. Some may be correlated to it and some may be absolutely not related to any kind of these external events. If you spot those, I think you should load upon those. These may be big opportunities for you. And the next 2-3 months are going to be volatile, and therefore you may want to, instead of investing all the money in lump sum, want to stagger it over a period of time. But one thing you should also remember in your mind is that once the event of Russia-Ukraine goes out or Fed goes out, there will be another event. There will be another China that will come up. So there will be events over events over events over a period of time. Therefore, you should ignore these kind of large events and focus on creating a long-term portfolio for yourself. In the next video, I am going to tell you how you can build a 5 to 6x portfolio in the next 10 years. I think it is quite easily possible provided you get your calculation and investments right. I'm going to show that calculation live in my next video. Please do watch the video and click that subscribe button now. Good luck and happy investing.